Hi, I'm Jeff Segal, CEO and founder of Medical Justice, focused on keeping doctors from being sued for frivolous reasons. We also help doctors manage their internet reputation and assorted other medical legal risks. I'm both a board certified neurosurgeon and an attorney, so I went over to the dark side. I'm now an attorney, but I'm not so much on the dark side because I defend doctors and I work with physicians to help mitigate risks that they experience. Much of our focus is on professional liability, but we also deal with a host of other thorny issues, including medical board complaints, National Practitioner Data Bank, et cetera, et cetera. You know, the collection of paper cuts that you experience in your practice. All right, let's chat today about professional liability insurance or medical malpractice insurance. I wish I had known more about medical malpractice insurance when I started my career. We just don't learn about it. Honestly, we spend so little time in medical school, residency, and fellowship talking about things other than the practice of medicine. It takes an entire training session just to learn how to get things right, but we don't talk about how things can go wrong and what should be done in advance of that. So let's do a deeper dive in terms of medical malpractice insurance. This is not going to be a snoozer, by the way. You definitely need to stay awake for this. This is important. All right. So, yeah, we chatted about most of the time we get very little information. Some doctors will actually just purchase their own professional liability insurance directly from a website. Others, I would argue some of the smarter ones, will get a broker to help them manage the process, but you still need to be an informed consumer so that you know precisely what you are getting. And some of you actually will become employed physicians and you will just get malpractice insurance from your employer, but you really won't know what is being covered and whether the contract actually is in your favor or not. Typically, you can expect that your employer is not going to deliver a contract that's in your favor, but at least it could be less in their favor. There are ways to manage this. All right. So the two big types of coverage would be an occurrence policy and a claims made policy. An occurrence policy and a claims made policy. Okay. So occurrence policy is less typical, more unusual. I call it more of a unicorn. Why? Well, it's more expensive. So if you're having to purchase it on your own or if it's being given to you by an employer, it's because it's more expensive, it's less likely to be given to you. So, what is meant by an occurrence policy? It means that if you perform some type of medical diagnosis or treatment and it turns into litigation, you're covered as long as you had this coverage in place during the occurrence, during the medical act. You don't need to purchase tail coverage. We'll talk about tail coverage and why it's necessary in other types of um, policies, but not with an occurrence policy. So, for example, let's say I have an occurrence policy, and then a week later, I perform an appendectomy and I kill my patient. Okay, a horrible outcome. And then a month later, I'm sued. If I have an occurrence policy, I'm covered. In that same example, let's say I perform the appendectomy and this patient still dies. And 5 years later, within the statute of limitations for that state where I probably wouldn't want to be practicing, I would not want to practice in a state with a 5 year statute of limitations, um, I end up getting sued. Again, because it's an occurrence policy, I'm covered. I did not need to purchase tail coverage. The only element of importance is whether I had this occurrence policy in place when I performed the appendectomy. In contrast to that is a claims made policy. So a claims made policy is much more prevalent, much more common, and it's less expensive. So there's a correlation between the fact that it's common and less expensive. So what is the difference between the two of them? Well, you need to have been paid in at two seminal moments in time. One is when you performed the medical act, which led to an allegation of negligence, and the time the patient files a legal claim, hence the word or the name claims made. So you need to have paid continuous premiums in that window of time between the medical act and the legal claim. And that could be a long time. In that example I gave previously, the appendectomy and then a legal claim 5 years later, I would need to continuously pay premiums year after year with that carrier to be covered for the legal claim associated with that appendectomy. Now, you can change carriers, and it is possible for you to avoid having to pay premiums indefinitely. But if you want to have the original carrier pick up the tab for a later legal claim, you will also need to purchase tail coverage. You'll need to purchase tail coverage from the carrier that you were leaving because you want indefinite coverage for all those medical events. So why would you ever want to change carriers? Well, you may end up finding a carrier that's cheaper. You may move to a different state. You may practice a different type of specialty. There are all types of reasons when you may want to migrate from one carrier to another, but be aware that if you want to make sure that all of the medical events are covered, when you leave, you'll need to pick up tail coverage on your way out the door. And I know you think that, well, look, I'm not aware of any complications. I probably don't need to pick up the coverage. But the truth is, you don't know what you don't know. If you saw a patient and gave them a diagnosis and it turned out it was actually cancer, something that was horrific, but not something benign that you recommended, and they ended up getting care elsewhere, how would you know? You actually wouldn't know. And actually, I had this calculus because when I left Indiana to move to North Carolina, I started thinking about, I can't think of any complications on the way out the door. By the way, this is just stupid thinking for a neurosurgeon. There's no way I should have been having this internal dialogue with myself. But in any event, um, having moved to North Carolina, I actually was sued. I was only sued one time. And it was after I left, and I didn't see it coming. Why? Because I had left, and the patient had followed up once with my partner. Didn't seem to have a problem, but then he ended up going to another physician who threw me under the bus. So you don't know what you don't know. My general mantra is you should have continuous coverage with whatever policy that you pick up. If you decide to change carriers, you need to think really strongly about tail coverage or an equivalent. And there are equivalents, and we'll chat about that in just a little bit. All right, policy limits. Most doctors in the United States have $1 million and $3 million limits. What does that mean? It means they'll cover you up to $1 million per claim, but they'll cover you up to a maximum of 3 claims in any given policy year for a total of $3 million. You can do the math. So 1 in 3 is, I would argue, the norm. But I don't think that $1 million is going to cover a life care plan for somebody who was quite injured. So, for example, if you're doing an anterior cervical discectomy on a patient and they develop quadriplegia because of your actions, $1 million is not going to cut it for a life care plan. I mean, it's easy to imagine, over $10 million. But I can tell you that if you just look at the literature that's out there and surveys that have been completed by plaintiff attorneys, most of them will accept that $1 million policy limit. The way they are able to collect more money for their clients is to sue multiple defendants and also going after the hospital. So the hospital has deeper pockets. They're not constrained by a $1 million policy. They often either self-insure or insuring captives. We don't need to get into the details of that. Suffice it to say that $1 million is typical for what doctors have, and most plaintiff attorneys will accept that number as a way to avoid going to court. So do states force you to purchase professional liability coverage for licensure? And the answer is the vast majority do not. Apparently some do, and my understanding is there are 7 that are out there, and I'll just go through the list here. Colorado, Connecticut, Kansas, Massachusetts, New Jersey, Rhode Island, and Wisconsin. I do not know the level of proof that needs to be provided to the state. It may very well be just a test to it, or maybe something that you have to know. Um, but in any event, most states do not require that you carry professional liability coverage to get your license. But I can tell you that if you work at a hospital, the vast majority of facilities do mandate that you have professional liability coverage as a condition of staff membership and obtaining clinical privileges. Why? Because they don't want to be the entity writing the check if there's a mishap at the facility. There have been exceptions in the past. I remember a number of years ago, and it may still be the case today, that in southern Florida, such as Dade County, um, it was almost impossible to get insurance professional liability coverage that was available or affordable. And the hospitals realized that if they didn't do something, if they didn't make it easier for doctors to participate and deliver care at those facilities, they would just leave and go elsewhere. So they waived the requirement that doctors, have coverage. In Florida, there's a quirk of the law that says you need to at least be accountable for up to $250,000, either with insurance or posting a bond or a letter of credit to maintain your licensure. But you don't have to have professional liability coverage to practice in Florida. You just need to demonstrate you can write a check for up to $250,000 to maintain your licensure in Florida. These are details. We'll probably go into that in just a bit. So some states require a requisite level of coverage if you want to take advantage of tort reform limits. So I practiced in Indiana. Indiana had what is known as a patient compensation fund, similar to the other states that are on here. There are various types of patient compensation funds where if you participate, um, you have your primary carrier that pays the first layer of coverage, and the patient compensation fund pays the overage up to the maximum limit. And I won't bore you with the details, but this is nice to have. If you participate in a patient compensation fund and follow all the rules, your personal assets should not be at risk because there's a limit. Now, there are always exceptions to this, but by and large, that is the reason we have, or why the states have these types of systems in place to provide a reasonable amount of coverage for injured patients, but also to make it more attractive for physicians to practice in that particular state. If your assets are always at risk, it makes it a little bit harder. Now, does that mean that you don't have any assets at risk? No, it doesn't mean that, but it just means that there are tort reforms in that state, and you certainly would like to take advantage of them. So we chatted briefly about Florida, and Florida at one point, many of the hospitals said you don't have to have professional liability coverage to practice in the hospital, but the state mandates a minimum amount of cash to pay a judgment. So that cash could be by having insurance coverage, by posting a bond, by getting a letter of credit, and so on and so forth. If you choose to go without insurance in Florida, your patients need to be aware of it. There needs to be a sign in your office, may very well dictate the font and the color and where it has to be positioned so that patients are served notice. But in Florida, you can go bare. You don't have to purchase professional liability coverage. And what's interesting is Florida actually allows you to purchase a $250,000 policy. They're still more expensive than in other states because Florida doesn't have substantive tort reforms in place, and it can be expensive to practice there. Settlements and judgments can be quite high, so it can be costlier than practicing in a state, for example, like Nebraska. So some states will sell policies with lower limits, or it's common. In Texas, I often see $200,000 policies. If you multiply that by three to get the three claims in any given year, that gets you up to $600,000 in any given year. In Florida, they sell $250,000, $750,000 policies. Now, Do I think this is a great idea? I personally am not a fan of these lower limit policies. I am not a fan of just getting $200,000 in coverage or $250,000 in coverage in medicine. Why? Because the likelihood of you requiring more to deal with an injury is not insignificant. And if the patient does have a significant injury, you're going to feel threatened. I mean, you're not even going to get a chance to really defend yourself. They're going to say, tender policy limits tomorrow, or we're going to go after, other assets that you may have, like your investment account. And so if you really want to fight the righteous fight, you're probably going to want to have a minimum of $1 million of coverage. Why? You don't want to put your entire nest egg at risk just to prove a principle, just to get your day in court. And we'll talk about things you can do, but having a minimum of $1 million in most states is not dramatically expensive. I don't know how much money you're saving with getting a $200,000 policy, but I can tell you, I have as clients individuals who have these lower limits on policies, and when their patient had a very challenging complication, they didn't feel as if they would get their day in court. They knew pretty quickly they were going to have to roll over, ask their carrier to write the check, and in some cases, have that check um, buttressed with additional um, funds, personal funds. And well, you can argue that, well, look, I've been saving money by not having to buy a $1 million policy. It still hurts when you've got to write an additional $150,000 check just to make this case go away. $1 million policy limits, I think, is a good idea. So I've had doctors ask a different question. Should they get a $5 million policy? These are people that do high risk procedures. And there's no great answer for it. I think for most doctors, the answer is addressed by the cost. If a $1 million policy is kind of expensive, a $5 million policy is going to be pretty pricey. Is it 5 times as much? Sometimes it is. Sometimes it's not. But by and large, it's not going to be a modest increase in cost like an umbrella policy. So, for example, I have a $1 million personal liability policy for my homeowners, but I also have a $5 million umbrella policy. The additional cost for the umbrella policy is not particularly high, but the actual cost for the underlying policy for personal liability is also not that high. I generally don't think it's a great idea for a $5 million policy for a couple of reasons. One is that it costs a lot, just in terms of premiums. And number two, I think it does make you a juicier target. If everybody else has $1 million and you've got 5 million, I think a plaintiff attorney will go to the end of the earth to try and collect policy limits from your $5 million policy, particularly if his client, your former patient, was injured. And that means even if you weren't the primary protagonist in causing that injury, if you were a peripheral player, but you have the $5 million policy, I think you're going to probably spend more time in a courtroom than your colleagues who may be more culpable. So it reminds me of the famous line by Willie Sutton, a bank robber. They asked him, "Why do you rob banks?" And he said, "Simple, because that's where the money is." And I think if you get a $5 million policy, while some may rest more comfortably at night knowing that it keeps their nest egg segregated, I still think the likelihood of you being drawn into a much longer suit goes up. All right, now that we've talked about kind of the framework for policy, what are things we like to see in a policy? So one thing I really like to see is a consent to settle, a language which says that the insurance carrier will not settle a case unless you explicitly approve. Typically, that's in writing. That means they need you to say yes. And this is actually a helpful negotiating posture. I like the idea of the carrier being beholden to you. If you believe that your case is defensible, your carrier can and will defend you to the end of the earth. And I think by telegraphing that to the other side early on, it makes it more likely that a case without merit will go away. So consent to settle language is something that I really like to see in a policy. Now, are carriers stupid? Do they allow you to defend any case to the end of the earth? Well, some do. I'm not calling them stupid, but I do think that for many of them, that's such a valuable marketing clause, marketing language, that they leave it in there and they draw attention to it. They say that we will defend you to the end of the earth. We believe in doctors. But in some policies, there is a second clause, and it's colloquially called the hammer clause. You will never see it called a hammer clause in a policy, but that's what it is. And it's the counterweight. It's the balance to the consent to settle provision. So here's how it goes. If the carrier could have reasonably settled the case within policy limits, and you say no if you withhold your consent, and a jury delivers a verdict with greater liability, to this case, it could have been settled, you may be responsible for the overage. You may be responsible for the overage. So let's look at an example here. Let's say the other side says, we're willing to settle for $100,000. You've got a consent to settle policy. You say, no way, no how, I'm not going to settle. So this goes back, and the jury delivers a verdict of $500,000. So the carrier will say, remember this consent to settle clause. We acknowledge you have the right to, force this case to trial, and we would continue to defend you, and we have diligently paid your legal fees up to this point. But we also have the hammer clause in there, which says that we could have settled this case for $100,000. You remember that. And look what happened to us, or to you, $500,000 verdict. So we will pay the $100,000, the amount we could have reasonably settled the case for, but you're on the hook for the extra $400,000. That's tough. Now, I think this is the way the carrier gets you to behave more reasonably. If you've got a defendable case and you believe it's strongly defendable, then by all means keep going forward. But if you have a very weak case and the carrier is telling you you have a weak case, and maybe you have personal counsel that you have hired that says you have a weak case, and you have a hammer clause in there, I would pay attention to that. That may be a sign that the stars are not aligning in your favor, and it certainly would be better to get the carrier to pay the full $100,000 as a total liability, and you not being on the hook for $400,000. Reporting a claim. Virtually every policy I've seen says that if there's a high-risk event that could potentially turn into a lawsuit, you have a duty to notify your carrier if you want the carrier to cover the claim. So what is a high-risk event? Well, it's in the eye of the beholder. It's hard to say. I mean, if you have a patient that experienced an unexpected complication, perhaps a death or a stroke, I would argue that's a high-risk event, and I probably would report that to my carrier. If an attorney sends you a demand letter asking for cash, I would call that a high-risk event. I would turn that into my carrier. And I wouldn't delay too long. Why? I have seen entities take their time, drag their feet, thinking that they could potentially make this go away or have this not turn into a lawsuit. And in a claims made policy, the anniversary date passes and it's a new policy year, and they report after the anniversary date. The carrier may and likely will deny the claim. Why? They'll say, you didn't tell us. They'll say, we have to allocate funds, reserve funds for high-risk events. And in your past policy year, you gave us no hint that you had any high-risk events. Consequently, we reserve no funds for your case. We have no funds for your case. It's a new policy year and everything starts fresh. So with a claims made policy, you need to be really attentive to reporting, particularly before an anniversary date. If you have a patient that has a horrific infection 3 days before the anniversary date, and it takes you a week to get your act together and file the report to the carrier, will that be a showstopper? Will they deny coverage? they typically would not, because you reasonably timely made notice or gave notice to the carrier. But if you drag your heels, particularly after renewal of the policy year and the anniversary date, they can very well deny the claim. And in some states, the law will be on their side. All right, so what are the other things that I like to see in various types of policies? Well, there are things above and beyond professional liability. There are things that it would be nice to have coverage for. That would include licensed defense. For example, the Board of Medicine says a complaint has been filed against you, or an investigation has been opened, or we're going to discipline you, or we're going to suspend or revoke your license. It would be nice to have a policy that pays the legal bills to defend your license. And many bread and butter professional liability policies bundle in license defense, a modest amount, anywhere between $25,000 and $50,000 of coverage for legal fees. You can purchase standalone policies up to $1 million. I don't think these are particularly expensive, but I think they're a great idea, because if you need, it's like a parachute. If you don't have a parachute when you need it, you'll never need it again. If you don't have licensed defense coverage when you need it, and you can't afford to pay the tens, perhaps even hundreds of thousands of dollars to defend your license when you need it, you may end up losing your license, and you will lose your ability to earn a living. So just make sure that your professional liability policy does have some type of licensed defense coverage. And 50 is better, 50,000 is better than 25,000. And I would argue 100,000 is better than 50,000. HIPAA breach, many policies do provide some type of coverage for a HIPAA breach, and it's increasingly a problem with practices and healthcare systems across the country. This goes part and parcel with cyber liability. HIPAA just means that the Office of Inspector General will have an issue with your practice not comporting with maintaining confidentiality or breach of the Privacy Act. In addition, there are coverages available paying for legal fees related to action on your hospital, clinical privileges, responding to a Medicare audit. These are all extra bells and whistles that you can ask your professional liability carrier for coverage, or your broker to assist you in finding these types of coverage. They're not common. You don't need it. Most doctors do not have action on their privileges. Most doctors do not end up getting audited by Medicare. But if you do end up in the crosshairs with any of these, it can be rather expensive getting the type of professional help you need just to fight the righteous fight, much less, paying penalties associated with overbilling and not timely refunding Medicare, for example. Two other policies I just want to briefly touch on. One is cyber liability coverage. So, for example, if your system gets hacked and your protected health information is being held for ransom, and you're being forced to make a decision to write a check for the ransom, related to the ransom, or your patient's private information will go out to the dark web. It is nice to have cyber insurance, and $1 million of minimum coverage is the least amount you want. There was a very famous case over the past year related to a hospital system in Pennsylvania called Lehigh Valley, and their entire healthcare system was hacked by someone overseas. And I believe they asked for $5 million, and they said that they would settle for $5 million. But if they didn't deliver the funds, that they would start releasing protected health information. And the hospital did not timely respond by paying off the ransom. And the hackers started releasing all types of protected health information, including photos of unclothed patients with cancer getting radiation therapy. Became quite a mess. Patients collectively sued. I believe it was a class action suit, and I believe the amount where the facility settled was for $65 million. You don't need $65 million of coverage with cyber insurance, but I think $1 million is the bare minimum, and it's typically reasonably priced. And finally, I want to put in a plug for something called EPLI, Employment Practices Liability Insurance. It's the insurance nobody ever talks about. It's not particularly sexy, but it deals with things that you don't think about. It's not professional liability. It deals with employees, and your patients and your employees are the most likely sources of litigation in your practice. Deals with wrongful termination, discrimination, sexual harassment. And the problem is that even if you prevail on these cases, the legal fees will kill you. So you don't really win, you just lose less. So I think having this type of coverage, which is not particularly expensive, I think it's a must have. What's odd to me is that brokers don't make it available to every physician. I think this is a no brainer. It's EPLI. It's often sold in concert with your commercial liability insurance. So, for example, slip and fall, if somebody slips on a stair or carpet in your waiting room, you can ask your carrier to give you a quote or your broker for a quote for EPLI. Again, it's a no brainer. Just do it. Don't even think about it. What about non-renewal? So sometimes doctors get an ugly letter saying, we'll cover you, but we're not going to give you coverage for the next policy year. Why? Well, usually it's too many claims, or the perception of too many claims or too many high-risk events, or it could just be not many claims, but one single big claim. And they may say, well, we can't directly provide you coverage, but we will put you into what is known as a high-risk pool, also known as, well, you'll be paying a lot more for coverage. Your premiums will be much higher, or we can't even cover you in a high-risk pool, but we can recommend that you go to a surplus lines carrier that just deals with high-risk people like you, and you may be in the bad boys and girls club for several years until you carry on with a good record and work your way back into the traditional insurance pool. So non-renewal does happen. It's not particularly common, but it does happen. And I think with with settlements and judgments going up and up, I'm seeing more and more clients who say they've received this letter of non-renewal. All right, what are some other things to think about that sometimes practices don't pay enough attention to? One would be, do you practice in more than one state? If you do, you need to make sure your carrier is aware, and you need to make sure your carrier actually provides coverage in more than one state. Sometimes states abut one another and they don't provide coverage. Other practices have a bi-coastal presence, i.e. practice in New York City and Los Angeles, but there you would need coverage in both states. Does your carrier cover you in both states? They may not, but your carrier must know where you practice, where your principal business is, and where you are potentially performing services. And not only that, they need to know, let me see if I got this. They need to know what you do, not only where you practice, but what you do. Because you may be priced for a lower risk specialty performing higher risk procedures. So for example, if you're an ER physician and you have a med spa practice also, and you're performing Botox injections, is your carrier aware of Botox injections? Certainly they priced you for performing very challenging events, but if you have a complication related to Botox, they may say, look, we didn't cover you for that. We don't cover you. We're not going to cover you for that. Are you a medical director? If so, the people that you oversee, the people that you supervise, they must have their own primary coverage, and on their policies, they add you as a medical director. So they bundle in medical director coverage to their coverage. And if I were a medical director, I would trust but verify. I'd want to see precisely that they are indeed covering me on their policy as a medical director. Clinical research, if you're doing work for a pharmaceutical company, typically your bread and butter professional liability policy will not cover research. You'll need a separate policy. But if you're working for Pfizer, for example, you need to ask them up front, hey, how am I going to get covered if there's a mishap here? And they'll guide you in that direction. But your traditional bread and butter professional liability policy does not cover you for clinical research. All right, so these are some interesting things that are out there, ways for carriers to avoid covering, or sometimes they have to cover you. So, allegation of sexual assault during a routine clinical evaluation. So, I've seen this go both ways. If, for example, you're an OB-GYN performing a pelvic exam with a chaperone in the room and performing, let's say you're doing a pap smear, doing it within the standard of care, that doesn't sound like sexual assault. It sounds like a routine clinical examination. But let's say you're a plastic surgeon now doing a breast examination without a chaperone. Well, that probably further away from the standard practice of medicine, but still far away from sexual assault. And we've seen everything with a whole spectrum. So the question is, will the carrier provide a legal defense or pay a settlement and judgment? And certainly the duty to provide a defense is greater than the duty to pay out. And not uncommonly, a carrier will say, we'll get you a lawyer, but we don't have all the facts in this case. We will reserve judgment as to whether we will pay for a settlement and judgment until we have more facts. Sometimes, depending upon how a claim is characterized, you may or may not have coverage. So let's say you operate on the wrong patient or the wrong side or the wrong body part. You don't have consent to do that, for that. So if you don't have consent, in theory, that surgery is a battery. Battery is like assault. Battery comes after assault. And battery is typically not covered by a policy, but if it's tied to a medical procedure, you can make the argument that it should be covered. Punitive damages, damages above and beyond a patient's actual injury, like medical bills and lost wages, as well as pain and suffering. Punitive damages to make an example of you so that you never engage in people around, you never engage in this type of behavior again. That's often and typically not covered by a professional liability policy. We've seen non-coverage for an allegation of illegal discrimination. In this particular case, a trans patient went to a plastic surgical office. Actually, they didn't even go there, just called and asked whether they perform breast implantation procedures. And they said, well, we do, but we don't do it for trans patients. That immediately turned to an allegation of illegal discrimination. They turned it over. And by the way, this patient was referred to a transgender center that specializes in precisely this type of work in an academic center. So this patient was taken care of at a center that arguably had the expertise and skill to deliver the outcome this patient wanted, but the patient also wanted cash. And it was couched as illegal discrimination. Because of that, the carrier said they were not going to pay even for the legal bills. And inadequate informed consent can actually be negligence, which would be covered, or it can turn into battery, which is not covered. How it gets drafted in the complaint often determines whether the carrier will make payment or not. Should you get a broker? I think the answer is yes. You want a talented broker, and certainly we have the names of extremely talented and seasoned brokers. So if you get in touch with us, we can give you the names of people that are our go-to brokers. But when you need help, you do want to rely upon your broker. Why? If a mistake was made with a carrier, your broker may be on the hook for making it right. And the broker will understand what you do. Hopefully, you will explain to the broker what you do, how you do it, and the type of coverage that you need. But they'll be able to help you find the best type of coverage, cost-effective coverage with a carrier that's going to have some staying power over the long haul, and not just give you a bargain today. And typically, you don't pay extra for it. the cost is usually bundled into the annual premium. You're not paying a separate amount, which may be, the way people are used to paying brokers with real estate transactions. But typically, the cost is bundled deep within the policy premium. So I think you're generally well served by going with a broker to get the best type of policy for you at a price you can afford. All right, we talked earlier about switching carriers, and if you move from one carrier to another and you have an occurrence policy, I'm sorry, back up. If you have a claims made policy, you will need tail coverage. You will need tail coverage to give you continued coverage from your claims made policy. As I opened, if you have an occurrence policy, which is extremely unusual, and they're rare, almost like a unicorn, you won't need tail coverage. But for most of you listening to this, you will have a claims made policy. And if you switch carriers, you will need to purchase tail coverage from the original carrier. Now, there's something called nose coverage or prior X coverage, which you can purchase from your new carrier. So you would have to certify to your new carrier you're not aware of any potential claims that are out there. And if it turns out you were aware of a patient with a horrific complication, but you certified, hey, not aware of anything that's lingering out there, feel free to give me nose coverage, and they learn that there's a paper trail and that you were well aware of the complication, they may not end up covering you. So tail coverage is typically the easier thing to get. Nose coverage often is reasonably priced, and if you truly are unaware of any potential claim that are out there, it becomes a nice alternative to the need for tail coverage. Tail coverage is typically about 2 times the cost of a single year's worth of coverage. All right, so who pays for tail coverage? Well, it depends. If you have a physician employment agreement, they generally say, we'll provide you med-mal coverage while you're employed by the organization. It often says nothing about who pays for tail coverage, but if they say we will cover all events for while you were employed at the institution, that in essence is a type of tail coverage. But if they say we will cover you for any claims while you are employed, it's kind of silent as to what happens. Well, what if a claim is made after you leave? And so you just want to make sure that your language covers you for all medical events performed in the service of your employer. You want a functional occurrence type policy. If you're an employee, you don't want to leave the organization and find out the organization is covering itself but not covering you. We often look at employment agreements just to make sure that the language that we like to see is in there, or at least the doctor goes in with eyes wide open. So, if you're in a group, for example, you can spell out tail coverage. You could say who pays for tail coverage. If I were working for a group, I'd like to see that tail coverage is picked up by my employer. Certainly the employer would prefer that you pay for tail coverage on the way out. If you work for a large healthcare organization, we generally don't see consent to settle clauses in there. Why they call the shots? You're an employee. You've given up quite a bit by virtue of being a W-2 employee. But some language that we have put into contracts that most large entities can stomach is that to the extent you are sued and you've left, you will be able to meaningfully participate in the defense of a particular claim. And the entity will have an obligation to notify you of a claim. So they don't have the ability to settle the claim without you becoming aware of it. Then only later, as you're applying for a new license somewhere, you learn about it through a data bank query. All right, we're wrapping up here. So these are just some peripheral details. Let's say you are a W-2 employee for a hospital and 5 doctors are sued. Do you each share a single attorney? Do you each get your own attorney? The answer is, I don't know. It's going to depend upon the employment agreement that you have. And then next, this is pretty important, if a defense attorney is supplied to you, are they independent or are they a hospital employee? Are they also working for the facility? Are they going to outsource this to a seasoned defense firm? Obviously, I like the latter better, a seasoned defense firm. But I've seen agreements where they basically have all 5 doctors who are sued, all 5 W-2 employees, share a single hospital employed lawyer. Personal counsel. I serve as personal counsel for a number of physicians. This is somebody who looks over the shoulder of the attorney your carrier supplied to you. So just remember, your carrier supplied attorney does work for you. He wants to win, he or she wants to win, but they also kind of work for the carrier. And personal counsel only looks after your interests. So there are times when you want personal counsel to help guide you as to the risk of a case going forward. What is the likelihood that you may have to dig into your pocket to pay an beyond $1 million limit claim? And what would that look like going forward? Are there other issues related to licensure or reporting in other states? Personal counsel helps manage these particular headaches. All right, so let's wrap up. Med-mal insurance coverage, in my mind, is one of the most important policies that you can purchase. Also important is term life and disability insurance, to state the obvious. If you are a physician and you don't have term life or disability coverage, and you are insurable, meaning that you don't have some medical condition that would preclude you from getting covered, you definitely must get that. But med-mal coverage is equally important. I think we talked about the differences between claims made and occurrence policies. Most policies that are out there, most that are affordable, are claims made, which means you have to keep paying premiums between the medical event and the date a legal claim is made, or you purchase tail coverage to make sure that that gap is addressed. And I'm a fan of adding personal counsel to look over the shoulder of your attorney. This is a very, if you're sued and the case is a high visibility case, having personal counsel just to make sure I's are dotted and T's are crossed pays for itself tenfold. So it's worth it. I'm also a fan of using a broker to get the right type of coverage for the practice that you have. And also important to surround your existing med-mal coverage with other types of coverage, including licensed defense, cyber liability, and employment practice liability insurance. So I think that is our whirlwind tour of professional liability coverage. Lots of details. We only skimmed the surface. If you have any questions, please feel free to reach out to us at Medical Justice. Happy to help answer your questions.